compensation drives behavior, right? So when you are thinking about raising private capital, you have to think about how can the compensation that I can offer to my investors drive their behavior. So my very first investor was talking to her at the gym on the elliptical machine. And I had just gotten started in real estate, hadn't even bought a house yet. But I'd been to a private money seminar type of thing. And I said, I need some money to get started and invest my first property and these kind of things. And she had just recently divorced and had an IRA that she got through the divorce, or a 401k that got through the divorce. And she didn't know what to do with it. No financial experience at all, no knowledge of the financial markets. When I told her I'd pay her 18% fixed return, she did it. And she signed a 5-year note. I paid her annual payment every year on the anniversary date for 5 years. So on a $60,000 note, it was like 10 grand of interest every year. She loved it. And then she opened up more and funded deals and continues to fund deals today. Okay, so compensation drives behavior. Would you give somebody 18% return if you knew that would open up an opportunity for you to flip 2 or 3 houses a year and make 30, 40, 50 grand a pop? Hell yeah, right? Of course you would. That's what it's all about. So again, what's your mentality has to be that not only do I need the money, but I can provide my investor private lender a better alternative. So stock market's way down. Even the 5-year return in the stock market, right? The stock market's gone up a lot in the last 5 years. It's been on a bull run, the 3rd longest bull run in history. But if you factor in the recent correction, it's only averaged about 9.5% over the last 5 years. That's if you got in at the bottom in 2010, 2011 and rode that out to today. It's only averaged 9.5. And that's before you pay the commissions and fees. So you're net at 8.5. On a 10-year level, you're at 4.5. This is the material. This is the information that you're going to educate and teach to your potential private lenders. So they're predispositioned to invest with you. So you never have to beg or sell. Okay? Kyle, you deliver the same presentation. It's virtually identical.
Yeah, I mean, this is it. I mean, it's basically set up in 2 parts. What you're doing sucks. What I have is better. That's all it is. I mean, they realize that.
Right.
After this slide, it's pretty much, all right, what do you have that's going to make me more money? And that's all it is. It's not difficult.
So Kyle, you've seen the slide a million times. Go ahead. Tell everybody what they're looking at.
So I think this is probably the most important slide. And when I first saw this slide, I know nothing about the stock market. I have zero money in the stock market. Honest to God, I have nothing in it. I took my money from my old 401k job when I was a therapist. I rolled it into the fund, and that's where I'm at. But what you basically have to understand is that if you have money in the stock market, you're paying fees that you don't even know, right? People think, oh, I got a 12% rate of return. No, you didn't. You paid fees. The minute you put money in, money goes right into your broker's pocket, does it not? When you told me that, I was like, seriously? I'm like, that's how it works? Yes, that's how it works. That financial planner of yours, yes, he bought you a nice dinner at Ruth's Chris, but he, whether you make money or not, he still makes his money. He still gets paid. So that's really what this is that it just talks about expense ratios, and you had to explain to me what all these things even meant. I didn't know what expense ratio was, but basically all these are basic fees, with A-share commissions and B-share commissions and everything else that's there. Bottom line, what it comes down to is the minute you invest in something, you have a $100,000 investment. Now you're down to a $90,000 investment because $10,000 went out the door to pay, for that guy's Mercedes back there. That's how it works. We don't do that. The stock market has never offered a 13% rate of return, right? Or I should say a 16. Take out 3% of fees, you got to be averaging 16% to get a 13% rate of return, right? Did I do that math right? Exactly. So that's never happened in the history of the stock market. That's why what we offer is so much better. Plus, what collateral do you have in the stock market? Does your financial planner say, well, things didn't go as planned, but by the way, I've got collateral for you, though. It's going to be okay. Does that get offered to you? No. But
everybody thought they had collateral in Enron and WorldCom. And there was a stock that just dropped 60% last Friday. I forget the name.
Yeah.
Right? And even, Facebook came out of its IPO and lost 25% of its value. So what is stocks really worth? It's like a piece of real estate. It's what a willing buyer is willing to pay a willing seller. Now with stocks, it's different because you have millions of shares all over the world. People from all over the world that have invested in Apple Computer, right? Facebook, Google, all these different stocks. So there's international pressures, there's monetary pressures, there's political pressures that all affect the stock market that none of you can control and none of your private lenders and investors can control. But what we can control is the fact that I can buy a house in Land of the Lakes or whatever the hell you live in Chicago.
You've been to my house.
And yeah, I've been to your house. I know. It's a beautiful house too, by the way. Your refrigerator is like 4 times the size of mine.
I'm very hungry.
Giant freaking Viking fridge. It's amazing. But anyway, he can look and say, this house sold for $600,000, this one sold for $650,000, this one sold for $630,000. Mine's got to be worth about that. Mm-hmm. Versus this stock is worth who the hell knows. Okay.
When you came in, so what Josh is, he came to, we put on a presentation for probably 30 people over 2 days for potential investors that I had in the fund. And I think the biggest thing that you said that resonated, I think, with everybody after talking to them all was that you said kind of why you sort of switched from investing in stocks to kind of taking money out of the stocks was we have no control over what happens with Apple stock, right? Nothing. You buy Apple stock today, you don't know if it's going to go up, down, sideways. Nothing you do is going to have any impact on Apple stock. You buy a property near where you live, you control that, right? You control your own destiny. You control, is it going to go up? Is it going to go down? I mean, you control that. We teach you how to do it the right way, so value does go up. You make money in the end. Your private lender feels great knowing that they have collateral, plus they just got paid a 12% rate of return. You know what the next question from them is? When can we do that again? I have guys, literally, when are we doing this again? I've got money sitting here. I just freed up money over there. When are we doing this again? I send out an email to my private lenders. It's first come, first serve. That's kind of how it works for me. Who wants to have a first come, first serve from their private lenders to say, I want in on that deal, right?
Yeah, first person to respond. Brian Stark would tell me all the time he had a roster of private lenders that he had relationships with. He'd send out an email to fund a deal. First person to send an email back got the deal.
Yeah,
sometimes he'd get like within seconds. I'll take that deal. I'll take that deal. I'll take that deal. And then the guy that was second, third, fourth, fifth, 10th in line, sorry, can't fund that deal. But I got another one coming right behind it. You can fund that one.